Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Brian Stutland, Managing Partner at Equity Armor Investments, as well as Holly Ruxin, Founder and CEO of Montcalm TCR. We're here to discuss the Fed's March rate decision and its impact across multiple asset classes. And of course, we will see what's going on in the VIX, potentially what that is indicating. There's a lot of data to parse through this week. We have the Fed's March decision, keeping rates at 4.25, 4.5, and expecting two cuts later in 2025. That's how the market's interpreting it anyway. Inflation seems somewhat elevated due to tariffs, but likely transitory per Powell. Again, that word transitory is in there. Brian, there's a lot to digest. And I want to take a look at some levels this week with the Nasdaq 100 because that was the index leading the way, and it's also the index that's under pressure. So tell us what are some of the key levels that you're looking at.
Yeah, I mean, you mentioned leading the way. It certainly did. When you look at where it moved off the lows of 2022, it's basically went up literally 100%. And that's incredible for a major index. Obviously, the leaders, artificial intelligence, the nuances behind that, really this technology revolution, or at least people feeling that, has driven the NASDAQ significantly not higher. Now, when I'm looking at the charts, though, I have some bearish concerns about what's been going on. You talked about what the Fed decision is. It was a little wishy-washy where rates can actually go. And typically a NASDAQ type index, which is built on a lot of growth, likes lower interest rates. And so we didn't necessarily get that feel from him. And when I look at the trend channel that the NASDAQ had, it's kind of broken that. And so I kind of have this chart here to point out some levels. This sort of like 19,440 level is sort of an area that it's kind of hanging in there. I'd like to see the NASDAQ get back up above 20,000, get back up into that trend channel before I get really bullish about it, because otherwise it does kind of look like things are breaking down a little bit. And that has me a little bit worried about just the general broad market.
Well, let's follow on that a bit, Brian. I mean, if we get the rate cuts, could that lift tech stocks, right? We were expecting 6, 7 rate cuts last year, never happened. The fundamentals were great in the market, and we saw what happened, with the returns, right? However, on the other side, you have tariff risks, which could weigh it down. And again, the strategy is unclear. So, no one has a crystal ball here, right? But I don't think rate cuts are necessarily the story. I think it's really going to be contingent on how corporates are performing. If you look at, the tech sector, look at cybersecurity as an example. Look at the investment Google just made in Wiz. There are areas where the fundamentals and the base case for it still makes sense.
Yeah, it is interesting. I mean, you are seeing investments go into the tech space. And so that to me at least feels like the big corporate, big players, the big tech is still investing. They still believe in a bullish view to the upside. So that's the one bull case, fundamental case to this whole story where the NASDAQ can continue to get a lift here. I mean, the marketplace is expecting 2 rate cuts. It's gotten it wrong basically for 2 years right now, gotten really ahead of it. One rate cut might be enough to sort of move the market higher, but there's a lot of uncertainty around the tariffs that just sort of prevents that from happening. I think the Fed really wants to cut rates, but they just can't do it right now. They need to see how things sort of play out. So I'm looking ahead. Earnings coming up here in April, coming up very shortly. It'll be here before you know it. It's already spring right now officially. So before you know it, earnings will be here, and we'll get a clearer picture of how these big tech companies have performed over the last quarter, where we have had a lot of choppiness in the market, to see if that can continue to move things higher.
Holly, how about the impact of the Fed decision on interest rates? And is the momentum still intact to lower rates on the 10-year?
Yeah, I mean, I think that interest rates are an interesting place right now. And for people who want to have that in their portfolio, if you're looking at kind of a Sharpe ratio and you're looking at kind of what return you're getting for unit of risk, bonds are interesting, and the interest rates are at a decent place now, especially in the municipal bonds where you can get in a longer end of 4.5% tax exempt return, which is equivalent of a 6 or 7% return. So I think that the 10-year should be pretty stable. Inflation isn't really that high right now, so the chance of a cut is pretty good. So in terms of bonds being a good place to put money right now, it's certainly a good, especially for capital preservation and portfolios.
Right. So do you expect the Fed to actually make those two cuts by the end of the year? And again, are you worried tariffs will be more than transitory? I mean, we knew what the word transitory did when we're talking about impacts from the pandemic.
I really think at this point we have to see it play out. We're not seeing it play out. So if inflation is not going up, I think that all the economic rules that we've lived in the last 25 years, they're not really showing in the marketplace. And so obviously decreased interest rates will help improve the economy because it lowers your borrowing cost. So the idea the Fed wants that. So I think if they can get away with it, I think we'll definitely see another rate cut.
And Brian, we have to think about this as well. There's nearly a generation of investors and traders who have not been through a prolonged environment of volatility. I mean, your index is moving 25% year over year isn't necessarily the norm. So when you take a look at VIX and recent volatility trends, what's that indicating?
Well, certainly, at least we're seeing the VIX continue to make lower highs, meaning that there is an increase of volatility happening in the marketplace. And there's every right to have that, right? We have uncertainty around what the tariffs impact are. Are we really going to get rate cuts from the Fed? We also have geopolitical events that continue to sort of creep up. How is Trump going to handle all this and the policy behind that? Obviously, a lot's gotten done in the first, call it 100 days or so, but there's uncertainty of how much that actually can impact the markets here, right? And so the VIX sort of found this level around 15 that it's sort of based out, and we've been seeing volatility continue to rise. Now, last week we got a big spike in the VIX. We got a big volatility down flush. The markets had been trending lower here. The S&P down, almost over 5% on the year at the time, and the VIX spiked. Now it's actually kind of come off. The markets have kind of stabilized right here around this level, this 5,600 level in the S&P 500, that just below 20,000 I talked about in the Nasdaq, and we've seen the VIX come off. Now, historically, when we see that happen, the markets rise. Why does that happen? Is because institutional traders start selling puts in the S&P, picking levels around this area where they think the market can kind of hold in there, and we start to see the VIX sort of trend lower, even though the market is sitting at, basically weekly lows. So that could be a bullish sign for the market. If there's any indication of bullishness that I've seen, it's the VIX sort of coming back down below this 20 level, below its historical average. And maybe that's a sign that things can improve.
And let's switch gears to talk about the opportunities in municipal bonds and their appeal versus stocks. I mean, we haven't spoken about munis in quite some time. Holly, where does the value lie in the muni space?
I have loved munis for portfolio construction, and again, that capital preservation piece, because at the end of the day, you've got to look at the math. You've got to look at what you need in your own portfolio. And again, if you're going longer out the curve, which I have always tended to do for the last 25 years, because you want to extract as much as you possibly can, muni bonds are liquid, is when you're getting a 4% tax exempt rate, and you've got to look at what is the Nasdaq going to do and what are the markets going to do through the year. If you think they're going to do 6 or 7%, if we're getting back to 10, 15% annualized return, then great. We want to definitely be in the stocks and not certainly stock picking. But when you can get that kind of lower risk bond at a 4% tax exempt, then you're really looking at a tax equivalent basis of a 6 or 7%. And I think because we are not looking at increasing rate cuts, and we just went through that for the last couple of years, and municipal bond portfolios held up more or less fine. You certainly had some reduction in risk, and I certainly always recommend hold to maturity bonds. Actually own the bond yourself, maybe not necessarily bond funds. If you can get access to that, then it's a great environment for both having more stability in your portfolio, because a lot of people are certainly unsure of what the tariffs are going to do and where we're going to go, and then you actually get a tax equivalent return that's actually pretty good.
So would you say credit fundamentals are still solid at this point?
I think the credit fundamentals are fine. You want to make sure you're diversified and where your revenue is coming from. It's really important. And depending what state you're in and where you're taxable, you want to make sure you've got, utilities, you've got water, you've got airports, you've got school districts, you've got universities. You want to make sure you are not overloaded in one certain area when you buy munis. That is also really important.
Right. And of course, we know that stocks are facing uncertainty and munis are providing a defensive play at this point. Is that something, would you consider having munis in your portfolio regardless of this environment?
I always have clients have municipal bonds in the portfolio. I always have them have the piece that they want to live off the cash flow. Oh, always have that stability. When you wake up in the morning, you're not worried about that piece, and you know that if you need cash or you want to live off it, that's what your muni bonds can provide for you. It's a really important part of portfolio. Then you have your other piece of your risk, which you can weather up and down, and will hopefully at the end of the day, again, you want it to outperform. If you're going to have the equities, you want it to be 30, 40% better than your returns on your munis. And when you're starting to get more in parity and uncertainty, I think there's no downside to looking at municipal bonds right now and waiting to see how some of this plays out.
And Brian, I'd be remiss to not talk about gold and the rally that we've seen. I mean, the returns have been quite remarkable year to date.
Yeah, it sure has. I actually even have a chart on just the returns that gold has done really in the last just year or so, right? If you kind of look back over the last few years, gold typically gets a little bit overinflated. It kind of forms this long-standing base. And then there's this breakout that happens when people get concerned about inflation, when people get concerned about geopolitical risks. And what's interesting right now is the last time it broke out of the base into 2020, 2021, it moved 48% out of that basing area to the upside. We are almost to the penny up 48% from the last most initial base here that we saw basically going into 2022, 23, and the breakout that happened in 2024. So it'll be interesting where gold goes from here, because it's obviously had a significant move as people just get a little bit worried about all these geopolitical risks that are going on, and also the level of government debt that exists out there really needing to get taken care of, because obviously there's a little bit of a lack of confidence in the US dollar. That's probably spurred, the rise in gold as we've seen it.
Yeah, and you brought up a great point before. Has the run already been made? Is it done at this point? So when you think about investment strategies, is it still worth getting in at this point? How would you recommend managing that, whether it's in your portfolio or you're thinking about it?
Yeah, right. That's a great question. And I think one thing to start to look at now is using optionality when it comes to gold. And you can do that really two ways. You can trade options. GLD is an ETF. That's an easy way to do that. But another way also is to look at structured notes. There's structured notes out there that provide some level of protection. And when you look at sort of gold as it makes a high historically, there is some risk to the downside, but it's never really gotten more than 20 or 25% or so to the downside. So I would look to sort of add some level of protection or have a structured note that gives me some peace of mind on about 20% to the downside and still gives me some sort of comfort level to the upside. Growth notes are one structured note that comes to mind. That's a great way to play it to the upside. Another way is just to use options where I sell a downside put, maybe go a year out, 20% on the downside, where I'm willing to get long GLD, and I buy a call to continue to participate on the upside. And that's sort of some optionality ways to sort of play gold as it is right now, because I would not want to be outright buying gold or still continue to own gold after it's made such a huge run that it has made. I am bullish on it, but I'm cautiously bullish.
So would you go short as perhaps a tactical strategy?
I mean, look, if I think the momentum would have to shift a little bit. I mean, when you're looking at that chart, really, there's still a nice defined channel to the upside. So as a momentum trader, and sometimes we do this as traders, as advisors, and looking at sort of asset classes, the trend is still to the upside. So to short it is almost like, the opposite of trying to catch a falling knife. I may just be walking in front of a freight train to go short here. I would like to see some cracks. I'd like to see a pop in volatility in gold and sort of this trend channel to break. That's maybe when I think about shorting.
Yeah. And Holly, to wrap up here, of course, it always comes back to what your time frame is and what your investment goals are. So thinking about it through the lens of, an advisor and managing retail portfolios, perhaps that conversation might look a little bit different, and you're not looking for, those tactical moves. You're thinking more long term.
Yeah, I mean, the conversation always is with clients is what do you want to achieve? Where do you need to get on your portfolio? And either you've got enough and so you want to save it, or you need to be more aggressive. And I think always knowing that target will really help you figure out what you want to do. And again, you go into gold, but can you afford to lose it? Really understanding where your buckets are and understanding what you want each of those buckets to perform is the best way to construct a successful portfolio for your own needs.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.